the values we have used. Therefore, right, so we calculated the value under different, 40,000 and 60,000. So that means this is the weight we have considered for our calculation, right? So we did the analysis using these values, right? And then if the so here in this working sheet I have linked the graph to this data. If the correlation is 1, what happened to this graph? Right? What will happen to this curve? It will be a straight line, right? Because there is no real risk reduction. That means when we have two assets to create a portfolio, when we put risk and return, the standard deviation and the expected return. So when we have one asset with relatively low risk and low return, high risk, high return. So when we have two assets like this, and if you create a portfolio, right? If you create a portfolio, and if the correlation is 1, there is no risk reduction. You can increase the return. You can increase the return only with risk. So which means this will be a straight line. So you can increase return only while increasing risk. There is no risk reduction if the assets are perfectly similar. But when the correlation is low, right? What are the other correlation values we use? Right? After we use 1, we have used 0.5, right? 0.5. If the correlation is 0.5, what will happen? Then there will be a risk reduction and the curve will move towards the vertical axis, right? So this is the value we have got, 15.87, right? So here that formula I have given. So here risk will reduce, and if the correlation is even low, that means if these are totally unrelated assets, correlation will be 0 and the risk will reduce further. And when these are different assets, then what will happen? Risk will reduce further, and totally different assets. The lowest value for the correlation -1, you will see risk will reduce a lot. So that's why we can see the effect of correlation. So that means when the correlation is low, so here you can see only two assets portfolio, but different combination, because with two assets, right? So you can create number of different portfolios. Only two assets, right? 90% in one asset, 10% in the other, 80% in one asset, 20% in the other. So like that. So here few points I have included here, right? So in this way, with two assets, you can create so many portfolios, right? So when you decrease the weight of this asset and increase the weight of this asset, what happens? The return will increase, and the impact to the risk depends on the strength of the relationship. When the correlation is reducing, right? When the correlation is reducing, what happens? There will be, right? So it is possible to increase return while reducing risk up to a certain point, and then it will start to increase, right? Therefore, if you get two assets, right, and one asset with relatively low risk, one asset with relatively high risk, so return will reflect the risk, and when you change the weight and calculate the risk and return, definitely you will get a graph like this. And when the correlation is decreasing, this curve will move towards the vertical axis, right, as we saw here, right? So the risk will reduce, right? Therefore, when we know this +1 and -1, these are theoretical values. Always correlation will be between +1 and -1, right? There may not be two assets perfectly similar, there will not be two assets perfectly different, right? Therefore, even in the same industry, the two companies will not be perfectly similar. Therefore, the risk will reduce to some extent, but to get the real benefit, the correlation should be very low. And so when you use two assets and create a portfolio, right, by changing the weights, what will happen? So it's possible to identify the risk return. So all these points represent portfolios. All these points represent portfolios that can be created by changing the weights. Right? All these points represent portfolios. that is possible to create with these two assets. That's why we use a term for this. We call this opportunity set. This is called the opportunity set. Opportunity set. When there are two assets, when there are only two assets, by changing the weights of these two assets, it's possible to create so many portfolios, and the impact to the risk depends on the strength of the relationship. Right? Therefore, this is the opportunity set. This is the opportunity set. Right. Now, if you increase the number of assets, in this portfolio, right? So this is the return of, expected return of the portfolio when there are two assets, and this is the risk of the portfolio when there are two assets. If you add one more asset, if you add third asset to this portfolio, what will happen to this formula? How many new terms will be added here? If you add one more asset, now three assets there, right? So this is the expected return of the portfolio formula when there are two assets. To add one more asset. So how many new terms you need to add here? How many additional terms you need to add to this one, right? To the return formula, expected return of the portfolio formula. How many new terms you need to add? Only one. Because right now three assets there, right? Then what you need to do? Weight of the third asset should be multiplied by the expected return of the third asset, right? So that means when you add one more asset, there will be one more term. What is the weight of the third asset? And what is the expected return of the third asset? Always the total weight should be 100%. Right? Now here, so if 100,000 there, 40,000, 60,000. Right? When there are three assets, right? So if you are going to use the same capital, then maybe 30, 30, 40. Always total weight should be 100%. Right? So here this will be the formula. When you add one more asset, there will be one more term. What happened to the risk formula? Right, so this was the return formula for two assets. When you add third asset, this is the formula now. And this is the risk of the portfolio when there are two assets. Now you added one more asset. How many new terms should be added? Yeah? One more. Now how many correlations will be there? Three correlation terms will be there. Correlation itself, three terms will be there. Right? That means, and here, weighted average standard deviation term also should be there. Right? That means, now what will happen to this formula? So here we need to add weight of the third asset, the standard deviation of the third asset, and we need to get the square. And in addition to that, here, two more correlation terms will be there. Right? For the first asset and the third asset, what is the covariance between one and for the second asset and third asset, what is the covariance between, right? So when there are three assets, three correlation terms will be there, right? Why? 1 and 2, 1 and 3, 2 and 3. Three correlation terms will be there, and three weighted average standard deviation terms will be there, right? So when there are two assets, only three terms are there. Now when there are three assets, six terms will be there. And if you add one more asset, here there will be only one more term. Always expected return formula will increase by one additional term for one additional asset. But what about risk? Now when you add one more asset to the portfolio, when there are four assets, how many correlation terms will be there? Because we know when there are four assets, four weighted average standard deviation terms will be there. And in addition to that, how many correlations will be there when there are four assets? Six correlations will be there, right? Six correlations will be there, right? 1 and 2, 1 and 3, 1 and 4, 2 and 3, 2 and 3 and 6 correlation terms will be there. There will be this number of correlation terms, n into n minus 1 divided by 2. This number of correlation terms will be there. That means if there are six assets, how many correlation terms will be there? If there are six assets, how many correlation terms will be there? 15 correlation terms will be there. 6 into 6 minus 1, that means 5. 6 into 5 means 30, divided by 2, 15. 15 correlation terms will be there, and 6 weighted average standard deviation terms will be there. 21 terms will be there. right? That is a multiplier effect. Therefore, when the number of assets increase, it's not possible to do this manually, right? So that is happening to the formula, right? And what happened to this graph? So this is the opportunity set when there are two assets. Definitely it will be a curve, either linear or non-linear curve when there are two assets. But when you add more assets, then there will be more opportunities, right? There will be more opportunities, so which means, right, so there will be number of other portfolios you can create, right? So many portfolios you can create. All these points represent portfolios that can be created, right? So when you add more assets, there will be more opportunities. Number of other portfolios can be created. So we can't identify whether linear or non-linear pattern. So there will be so many portfolios, right? All these points represent the portfolios when you add more assets, right? So that is the opportunity side. Now, so based on this, Harry Markowitz he tried to analyze this portfolio theory, which he called mean variance analysis, right? So which is based on number of assumptions, right? So he did that analysis using number of assumptions, right? So which are fairly simple, practical assumptions. The first one, all the investors are risk averse. Risk averse. That means not willing to take risk, right? Unless there is a, right? So investor will take risk only if there is a higher return, right? So all the investors are risk averse, and the analysis is based on, right? So it is also assumed we know the expected return and the standard deviation covariance of all the assets in the portfolio, and the analysis is based on only this information. And to simplify the analysis, it's also assumed there are no taxes or transaction costs, and based on this risk and return has been calculated. So this is what we already discussed. The expected return of the portfolio we can calculate this way, right? And this is the variance, and we can calculate the risk of the portfolio, but it is not only the weighted average standard deviation. In addition to the weighted average standard deviation, we need to consider the strength of the relationship using either covariance or correlation, right? So we discussed the meaning of this covariance and correlation. Covariance, we discussed the main problem that can take any number. That's why we call the covariance is unbounded. It can take any number, which range from negative infinity to positive infinity. That's why correlation is more meaningful. That will have only value from +1 to -1, right? And based on that, we can calculate the variance or we can calculate the standard deviation. So standard deviation, as we discussed, this is the standard deviation when we use covariance, and if you use correlation, only the third term we need to change, right? To weight of the asset A, weight of the asset B, correlation of asset A and B, which should be multiplied by the standard deviation of A and standard deviation of B. So we can write this way. Okay. And when you increase the number of assets, what happens? When there are 3 assets, there will be 3 correlation terms, right? So in addition to the weighted average standard deviation terms. When you add 1 more asset, that means when there are 4 assets, there will be 6 correlation terms, right? So like this, there is a multiplier effect. And when you add more assets, what happens? There will be more opportunities, so we can identify, right, what are the different portfolios that you can create with number of assets in the portfolio, right? Now the next point, right? The next point. Now, if the investor expect a certain level of return, example, suppose a particular investor expect this return. Now, to get this return, we can see there are a number of portfolios. Right? So to get this return, we can see this is one portfolio, this is another portfolio, this is another, this is another. So number of portfolios are there, which which is expected to generate a certain level of return. Out of these different portfolios, what is the best portfolio for the investor? Right? To get this, right? When the investor expects this return, right? For this expected return, what is the best portfolio? There are a number of portfolios. Out of these portfolios, different portfolios, what is the best portfolio? Portfolio with the lowest standard deviation, lowest risk. That means, right, this is the best portfolio. Right? Same expected the return but low standard deviation. So in this way, for any given return, we can see what is the portfolio with the lowest risk, right? For any particular return, we can see what is the portfolio with the lowest risk, and then we can draw a curve. Using the portfolio with the lowest risk for a given level of return. Right, now we know definitely the portfolios on this curve have the lowest risk for a given level of return. So when you consider portfolios on this curve, definitely better than the portfolios inside the curve. Right? Is that clear? Right? Portfolios on the curve better than the portfolios inside the curve. Right? Why? These portfolios have the lowest risk for a given level of return. For any given level of return, these portfolios have the lowest risk. Right? Then the next point. So when we consider this portfolio, is it an efficient portfolio or no? Right? If you have the opportunity, right, to invest in a portfolio, right? So is this an efficient portfolio? Is this a good portfolio? Right? No, it's not efficient portfolio. Why? Exactly. Even though this is the portfolio with the lowest risk for this level of return. That's true, right? For this level of return, definitely this is the portfolio with the lowest risk. But if you are going to select this portfolio, this is the risk we have to accept. But if you accept that risk, this is not a good portfolio. Why? For the same risk, you can see there are much better portfolio with higher return. Therefore, even though this is a minimum, the portfolio with the lowest risk for this level of return, it is not an efficient portfolio. Because we use a special term for this curve, right? There is a special term for this curve because all the portfolios on this curve have the lowest risk for a given level of return. So therefore, this curve is known as minimum variance frontier. Minimum variance frontier. Right? So minimum variance frontier, as the term implies, portfolios on this curve have the lowest risk for a given level of return. It has the lowest risk. But we can see all the portfolios on the minimum variance frontier are not efficient. Right? For example, this is not efficient portfolio. Right? So when you compare portfolio, right? Let's say the portfolio, this is portfolio A, this is portfolio B. So if you have the option to select between portfolio A and B, which one is better? A and B? B is better. Right? But B is not an efficient portfolio. Why? For the same level of risk, you can have a portfolio with much higher return. Therefore, we have to select the portfolio with the highest return. So that means, so when there is a portfolio, right? So when we have to compare with between B and C, definitely C is better, right? So that means B is not an efficient portfolio. Right? And that means when you use this minimum variance frontier, in the minimum variance frontier, portfolios in a certain range are not efficient. Right? What are the portfolios that are not efficient? In which range? What is the range of the minimum variance frontier that are not efficient? So this condition is applicable to all the portfolios in which range? In the negatively sloped range. In this negatively sloped range, all the portfolios are not efficient. Right? Why? So when you consider any portfolios in this negatively sloped range, you can see for the same level of risk, you can have much higher return. That means what is the efficient, what is the range that shows the efficient portfolio? The efficient portfolios are in the positively sloped range. Right? So the portfolios on the efficient, on the positively sloped range of the minimum variance frontier. That is, these are the efficient portfolio. So therefore, this positively sloped range, that is known as efficient frontier. Right? So this is the main point developed by Harry Markowitz in his portfolio theory, which was further expanded by some other finance professionals later. Right? This is the initial part. Efficient frontier. So efficient frontier. The portfolio will be efficient only if two requirements are satisfied. So we can see there are two requirements to consider as an efficient portfolio. Efficient portfolio has, right, two things. Efficient portfolio has, right, two things. What are the two things? The lowest risk for a given level of return. For a given level of return. Right? That requirement is satisfied by portfolio B. But it is not efficient. Why? There is another requirement. It also should have the highest return for a given level of risk. Right? So not only this, the highest return for a given level of risk. When both these requirements are satisfied, only the portfolio will be efficient. A portfolio will be efficient only when both these requirements are satisfied. A portfolio will be efficient when it has the lowest risk, right, for a given level of return, and the highest return for a given level of risk. Both these requirements should be satisfied. Right. So that's why when we can easily compare portfolio A and B. So when we have to compare portfolio A and B, we know B is better. Right? Why? Same level, same return, but lowest risk. And when you have to compare portfolio B and C, that's easy. So we know C is better. And when you have to compare portfolio C and D, which one is better? Right? A and B, B is better. B and C, C is better. C and D, which one is better? Yeah? C is better. Right. Okay, if you are telling C is better, so that is not incorrect. That indicates you are highly risk averse investor. You are not willing to take much risk. So if you are telling D is better, that's also not incorrect. That indicates you are willing to take risk. Right? Therefore, when you compare portfolios on the efficient frontier, we can't say C is better than D or D is better than C. That depends on the level of risk investor willing to take. Right? So highly risk averse investors will select portfolios with relatively low risk. And there are investors we call risk seekers, risk lovers. So they will select portfolios with high risk. Therefore, the selection of portfolio on the efficient frontier, definitely rational investor will not select portfolios inside this curve. That's not a logical, that's not a rational decision. Or this negatively sloped range of the minimum variance frontier. That's not the correct decision. But the portfolios on the efficient frontier, so we can't say C is better than D or D is better than C. That depends on the level of risk investor is willing to take. We also mentioned one concept which we didn't discuss in detail last day, utility. Right? So because some investors are happy with relatively low return, but some investors they want to get more and more return. So then in order to do that, they will take more risk. Right? Therefore, an investment decision completely based on what? The level of risk investor willing to take. Right? Therefore, the selection of portfolio C or D, right? Or portfolios on the vision frontier, right? We can't say C is better than D or D is better than C, right? But we discuss one value we can use to make that decision. What is that? When both risk and return different, right? We can use one value. I think I mentioned last day. Right, because when we have two assets, like this, right, and if these are the expected return and the standard deviation, right, which one is better? That's simple. Asset A is better, right? Why? The same expected return with relatively low risk. And if there are two assets like this, right? If there are two assets like this, then what is better? What is better? D is better. Same standard deviation with relatively higher expected return. And but if there are two assets like this, now which one is better? That we can't directly say. Right? Why? The asset with here, that's easy to compare. Same expected return, we have to select the asset with the lowest standard deviation. Here, same standard deviation, we have to select the asset with higher expected return. But here, the asset with the higher expected return also has higher standard deviation. Then we can calculate another value. Right? I think I have not mentioned last week. So that is called coefficient of variation. Did I mention last week? No. Right. So that is called coefficient of variation. Coefficient of variation. So coefficient of variation measures the risk per unit of return. So it measures the risk per unit of return. So which is calculated? It is calculated standard deviation divided by the expected return. Right? Coefficient of variation. So we can calculate coefficient of variation, right? Sometimes called coefficient of variance, right? So which is used to calculate the risk per unit of return. I think under equity valuation we did that, right? We calculated, right? Yeah. Yeah. Coefficient of variation. Coefficient of variation, which is the standard deviation divided by the expected return, right? You may remember I mentioned in this study text, the way of giving that formula is wrong here. It's not expected return divided by standard deviation divided by expected return, right? So it is the coefficient of variation equals standard deviation divided by expected return. Standard deviation divided by expected return, because it measures risk per unit of return. Coefficient of variation measures risk per unit of return. Risk per unit of return. Risk per unit of return. So that is one way. That is one thing we can use when the risk and return different. So we can see which asset has the relatively low risk per unit of return. So which can be used to compare. Right? But that again, that does not indicate the investor will select the portfolio with the lower coefficient of variation. Selection completely based on the risk tolerance, right? The risk appetite. So some investors willing to take risk, some investors not willing to take risk, right? Okay. Now this efficient frontier. That part is that clear? So initial, so using two assets, how to identify the opportunity set? When you add more assets, what happened to the opportunity set? And using the opportunity set, how do you identify the minimum variance frontier? From the minimum variance frontier, how we identify the efficient frontier? Right? Is that clear? Right now, in the efficient frontier, as we discussed from the efficient frontier, the investor can select either low risky portfolio or high risky portfolio. But all the portfolios are risky. Some portfolios are less risky, some portfolios are high risky. But all the portfolios include risk. All these assets include risk. Right? But investor has another option to diversify further. Part of his capital he can invest in risk-free asset. Risk-free asset also, right? So risk-free asset also can be incorporated into this portfolio, right? We know practically there is no any asset called risk-free, totally risk-free, right? But usually, what is the asset we consider as risk-free? Yeah, government securities, right? So treasury bills we consider as risk-free, right? Why? We believe government will not default, right? Because the government has some special rights that the other issues don't have, right? Because they other issues, right? For example, when a private organization issues debenture or right, so in Sri Lanka no corporate bonds, right? But debenture, so if they don't have the money, so right, inflows to settle it, to pay the interest for the capital, they will default. But government, we believe they will not default, right? So they have special rights, right? Because if they don't have money, they don't have money, right? So normally they don't have money to settle these loans, right? So that means these borrowings, and so you all know what is the government debt liability, public debt liability in Sri Lanka. It's around, I think, 2020 annual report is not yet published, right? But 2019, according to 19 annual report, public debt liability in Sri Lanka is around. Sorry? 3 trillion. It's actually 13 trillion. Right? So that is 2019, 13 trillion, but so that is 13.3 trillion in 2019, right? But now, December 2019, but now it is much more than that at the end of 2020, because budget deficit itself may be closer to 1 trillion, because 2019 budget deficit exceeded 1 trillion, and this time there will not be a big difference, and especially right, so when you, this is 2019 values, right? So here, so in the annual report there is a special statistical appendix which include the information for the last, from the incorporation of the central bank from 1950. From 1950, key information there, here, from the incorporation of the central bank: population, national income, prices, inflation, balance of payment, all the key information here, reserves. This is the government fiscal operation. It's the right. It's the government budget. Sri Lanka budget deficit continuously there. In only 2 years, government has recorded budget surplus in Sri Lanka. It is in 1954 and 55. Right. In 1954, this budget overall fiscal balance positive, 24 billion. So here figures in millions. 55 also positive. Only these 2 years budget surplus there. and all the other years, right, budget deficit, and deficit has increased. See, deficit is increasing, and last year, in 2019 actually, it has exceeded 1 trillion for the first time. 1 trillion rupees, right? And how they fill the deficit? Only option, borrowing. Only option, borrowing. So to borrow, they use domestic sources and foreign sources, and they use what? Government securities, right? So in addition to the loans, they obtain mainly, right, government securities. They use bills and bonds, right, and this is the government debt, right? Because when there is a budget deficit continuously, what happened to these borrowings? Borrowings accumulate. Because when budget deficit is there, government can't settle any loan. Next year also they have to borrow, right? That means every year they need to borrow. And budget means that does not include debt repayment. Only interest payments there. Therefore, government has to borrow to fill the budget deficit, and in addition to that, every year government has to settle certain part of loans which they have taken previously. So how they settle that loan? That also they need to borrow, right? They take new loan and settle all loan. So that's why, I mean, they don't have money. So that means, right, even if they don't have money, they settle. Why? Right? How? They take a new loan and settle. Right? So that's why in central bank perform agency function on behalf of the government. Several agency functions there. So one of those agency function is public debt management. Right? So there is a department, public debt department. So they issue these government domestic debt management is done by central bank. Foreign debt, that's finance ministry. Right? So domestic debt. So then they issue bills and bonds, and so this accumulates. So this is, here, it is also figures in millions of rupees. In 2019, 13 trillion. 13 trillion. Right? It is 13 trillion at the end of 2019. Right? So now 2020 also over, so that year, so definitely this value is over 14 trillion. Because here you can see the way of increasing debt liability. Earlier, to increase from 1 trillion to 2 trillion, that means increase by 1 trillion, it took number of years, several years. But now see, here 6 to 7, 7 to 8, 8 to 9, 9 to 9. So within 1 year, it increased by more than 1 trillion. Because budget deficit itself 1 trillion. Budget deficit means that is completely new loans to fill the budget deficit. And in addition to budget deficit, because here you can see out of this 13 trillion, here this is domestic debt, this is foreign debt. Foreign debt almost 50% now, almost 50%. And this foreign debt valued using what? Using the exchange rate at the end of that year. This is 2019, 2020. So 2019, the exchange rate it was around 170 rupees, right? And 2020 it was closer to 200, right? So then you can see what happened to this debt liability, right? So due to the depreciation in rupee itself, the debt liability increased by 300 to 400 billion, right? So therefore, end of 2020 definitely debt liability more than 14.5 trillion, right? So that's why every year debt liability increased by more than 1 trillion. So that's why now some countries, they are very willingly giving loans. Why? They know there will be a point the country cannot settle this, so which they can get the control of national assets. So that's why a lot of issues are there now. So you may have seen certain parts of the country they have given without any loan, right? Certain parts, right? So that's what happens. So that means national assets should be sold at one point. But currently, right, so they maintain unblemished payment record, right? So they have not defaulted yet, right? Government has not defaulted yet, so that's why we call risk free, right? Because they settle. Still, right? So a lot of countries, they are very willingly giving loans, right? So here, all these assets, all these portfolios which I have considered for this analysis, risky. Some are less risky, some are high risky, but all the assets are risky. So we can incorporate risk-free asset to this analysis. Right? We can incorporate risk-free asset. Where do you mark the risk-free asset in this graph? If there is a risk-free asset, right? So we have to mark the risk-free asset in this graph. Risk-free asset, where do you mark that? Yeah, risk-free asset. Sorry? Right? So we have to mark on the vertical axis. Risk-free means no standard deviation. Risk-free means no volatility. No volatility. If it is risk-free means no volatility, no standard deviation. There will be certain return. So that's why usually we consider treasury bill rate as the risk-free rate, treasury bill as the risk-free asset. Therefore, the interest rate to the treasury bill, say 4%. So 4% we can get without volatility. So that means that should be marked on the vertical axis, right? So we have to mark on the vertical axis. Right, so this part we already know. Right now, the next point, risk-free asset. If we incorporate a risk-free asset to this analysis, risk-free asset. Now, the next point, next decision we need to make. The risk-free asset we can combine with different portfolios. Here we know there are a number of different portfolios. So this risk-free asset should be combined with which portfolio? That is the next decision we have to make, right? Because all we have a number of portfolios. The risk-free asset we should combine with this portfolio, right? So like this. So we have a number of portfolios. So the risk-free asset, what is the portfolio we should select to combine with the risk-free asset? That is our next decision that we have to make. The next decision we have to make is that. Right. Then, how do you right? How can we make that decision? Now, this risk-free, if we invest only in the risk-free asset, we can expect this return without standard deviation. But in order to get a higher return, so if you are going to combine the risk-free asset with risky asset, then what happens? Definitely, we have to face some risk. Suppose we are going to combine with this portfolio. If you are going to combine with this portfolio, we know now we need to face this risk. We need to face this level of risk. When we face this level of risk, right? So when we face this level of risk, now what is the? So that means if we invest only in this risky asset, this is the return we can expect. But if you want to get a higher return, you can combine with the risky portfolio, but you have to face the risk. You need to face this risk. Right? You need to face this. Right? This will mean an additional risk. Because if you invest only in the risky asset, there is no standard deviation. But if you combine with this one, you need to face this risk. That entire part will be the additional risk. For that additional risk, what is the additional return you get? What is the additional return? We know if you combine with this one, we can expect this rate. So what is the additional return? Additional return. Is that the entire part? No, because even without standard deviation, we earn risk-free rate. Therefore, when you invest in this risky asset, this is the additional return we get for this additional risk. For this additional